Good evening, everyone. Thanks for joining on a Sunday evening. And I'll make sure next 1 hour will add value to your trading, and you will learn some lot of new things, some new tips. So, just to give a quick quick review on what we learned last week. We learned like what are options, right? Options are nothing but it's an agreement or contract between a buyer and seller which gives buyer the right but no obligation. They don't need to do it. If they don't want, they can just walk away. But there is an obligation on the seller. What are the main reasons for options? One is for speculation, right? With a small investment, we cannot put a lot of money on, right? You cannot buy stocks like Tesla, Amazon with a small account. But with options, if you see a potential move, right, whether it is bullish or bearish, you can, instead of investing $1,000, maybe with $10 premium, you can get a similar advantage, or you can make money with a small investment by speculating the move upward or downward. The second reason is basically if you want to hedge, if you want to protect your stocks. The other reason generally we also buy option contracts is to hedge our portfolio. So we discussed about some examples, right? What are these call options, put options? We discussed with an example of a home, right? Home purchase. Sam, we want to buy this home with Susie. We discussed all these things, right? Where they get into an agreement. He is paying a premium. We saw all these examples last week, right? I don't want to again repeat. If somebody missed it, they can watch the recording. And also we discussed about a put option, right? Generally we buy a call option when we are bullish or when we think something will move up. We buy a put option when we are bearish, when we think something will go down. We can be on the buyer side, we can be a seller side. We can be on both the sides. It doesn't mean that every time we have to be a buyer of a put contract or a call agreement. We can be on both the sides, but for now, let us just assume that we are buying calls or puts, right? Later, we'll also get into why it is also good for, right, to be on the selling side. We'll see once you see, right, once you understand more about time decay, or once you understand about implied volatility, once you understand about intrinsic, extrinsic values, you will understand what are the advantages to be on the seller side also. But for time being, right, because I wanted everybody who doesn't know anything about options also to understand about right from the basics. So let's keep it simple, and then we'll slowly build up on it. Then we also discussed about put options. It is like buying an insurance, just like we buy home insurance or you buy your car insurance. You are paying a premium so that even though the value of that asset, it can be a car, it can be home, it can be your stock, whatever it is, if it goes down, you have a protection, right? You are paying a premium. When it goes down, that person will still buy that asset at the agreed price. So we discussed about these both calls and puts with various examples. Basically, in summary, last week what we discussed is a buyer, if you are a buyer of a call, you have right to buy in a certain period, in a certain duration, you have to right to buy that asset at a certain price. If you are a buyer of a put, you have right to sell a certain property within certain time period. You have right, but there is no obligation. If you are a buyer, you don't have obligation. But if you are a seller, or if you are a issuer of that contract, if you are the writer, right, then you have obligation. If you are selling a call, you have obligation to sell, right? In that example, Sarah agreed that she will sell it for 500K, even though that home in Austin goes to 750 or 800K, she has to sell it 500K. In the same way that insurance person, whoever is collecting the premium, he has to, right, obligation to buy. He has to buy that car, even though it gets into an accident, and even though the value of car becomes zero, he has to buy that car at 40,000 and pay 40,000 to that person who paid the premium for the insurance. So this is the summary, right? What is a call? What is a put? Again, right? Somebody might be thinking like, still, if they are not able to understand, right? With options, you have a time period, right? Within that period, it should happen, whether the upward movement or downward movement. There is a risk involved. Our premiums can become zero if that doesn't go as per our expectation, right? Then some of you might be still thinking, right? Why not we just put into stocks? Because there is, even though it may, right? Because there is no time period, there is no time decay. There is nothing like it should happen within 2 weeks or within 1 week or within 1 day or within 1 month. It may go down, but still, if you wait, if it is a good stock, it will come back again. So for low risk investors, right, that is an option. If they want to just invest into stocks, they can do that. But the disadvantage with stocks is, right, especially you have Amazon, you have Nvidia, you have Tesla, you have, right, for example, right, on Friday we saw some news about VRTX. They got some good earnings, and also Goldman Sachs, they adjusted the price target for VRTX to $389 from $368. Then right, then there are a lot of other right, these big companies, they also raised the target from to 300 from $275. So, right, fundamentally there is some good news, there is some strong catalyst. Then technically, right, we have two things we have to look, right, whenever you are buying stocks or buying options or whatever it is. Generally we look into two things. One is the fundamental aspects, the second is the technical aspects, the technical analysis. That is, what is the historical data, what it is showing. Is it crossing simple moving averages? Is it crossing exponential moving averages? Is it in a, right, is it crossing Ichimoku cloud? Is it above the cloud or below the cloud? Or, right, what is the RSI? You look at various indicators in the technical analysis. Whereas in the fundamental analysis, you look about the catalysts, right? Okay, is it a good company to buy? What is the latest news going on? Is it making profits or not? What these big companies like Goldman Sachs, they are thinking about this company, right? So our algo gave a buy, right? On Friday, if I look at, right, VRTX. So on Friday, for example, if I am in 30-minute duration, right, in 30-minute time frame, we got a buy on Friday, August 5th. Immediately I went to, right, Thinkorswim, looked like, okay, is something going on? Is there some good news or something around it? Immediately I saw that there are some lot of good news, lot of upgrades, analyst upgrades about this stock. So, right, I hope everyone is getting, right? We look into fundamental aspects of the stock, and also this algo is already doing the technical aspect, right? It is looking whether these SMAs, EMAs, all those things are crossed, whether this it is above the Ichimoku cloud, all those things. So it is above the cloud, you have a support somewhere here, and then you have a strong resistance somewhere at 290. So, right, immediately you might have seen that, right? We took this call, and also, right, we took a vertical spread where you can sell the 290 call, or you buy 290, and right, let me see like what is that we took on the day, right? We took buying VRTX $290 call and selling a $300 call, because there is a strong resistance at 290. It may go up to 290 and then come back. So it won't reach to 300. So that's what we did on that day. So when we took that contract, right, approximately around 11:05 on Friday, the premiums for 290 were approximately between 2.45 to 4.5, right? Let us say approximately $3.5, right? At the end of the day, right, if you see now, the premiums are approximately 5.5. That means, right, for example, if I want to buy a stock, if I have a $5,000 account, I see there is a strong fundamental catalyst. I see there is a strong technical analysis. There are a lot of good indicators. It crossed everything. It crossed Ichimoku cloud. The resistance is somewhere very far from the support. So there are a lot of good things from technical side. There are a lot of good things from the fundamental side. So I see there is a good potential to make from, right, from 270, 275, it can go to $290. I can see that, right? Or there is 80 to 90% chances of that to happen, unless we see sudden war news about China, Taiwan or something. There is a huge potential that tomorrow the stock will go to more than 290 plus, or approximately 290. And then again, it can retrace. Again, it can, if there is high volume, it can even cross 290, go to 295, like that. But with a $5,000 account, if I have a small account, how many stocks I can buy, right? I may be able to buy, if it is around 275, right? Again, I don't want to invest a lot of money in one stock. I may buy maximum 5 stocks or 2 stocks or 3 stocks. And even if it moves by $10, how much profit I make? If I am investing some $1,000, I may make $30 or $40, right? Which is less than, right? Maybe 2%, 3%, like that. But instead of that, what we did, right? What we can do when you see a strong potential, we bought a 290 call, right? Let us forget about selling the call for now. Let us assume that we are just buying a 290 call. For how much we bought it, right? We bought around 3.5. Again, if you remember, right? This is called as an option chain, and we bought it for, right? You have weekly expiries, you have monthly expiries. We bought for the 19th August monthly expiry, right? Which is 290 call, right? Again, as you remember, this is the calls. These are the puts. This is the strike price, right? Again, just always remember about those examples. House, right? When she kept it for 500K, he went and told that I don't have that 500K, but I will give you $5,000. Please hold this property for me for 3 months. In the same way, if I am buying a 290 call, what I am telling to that seller, right? Whatever is the, right? Because I am thinking that this stock may go to 295 or 300. What I am telling to the seller is, I am ready to pay you this 3.5 or $4 premium for each stock, right? Because we cannot do for each stock, we generally buy it for 100 stocks. So if the premium is showing as, right, as in the example, right, I told you 2.45 to 4.5 when we shared the alert. That means approximately $3.5 in between, right? It is, somebody is ready to buy it 2.45, somebody is ready to sell it 4.5. If we think like, right, if we want to buy it, there is a huge potential. I may buy it somewhere at the mid price, right? So you will, right, for example, you will click on this, then you will say that, okay, I want to buy somewhere here. And generally you get at the mid price between the bid and ask. So, right, so now instead of investing for 5 stocks or 10 stocks, investing in a stock, what I am doing, I am paying $470 for one contract, right? Or $350 for one contract, right? If you take this example, for 290 call, my intention is, I am telling to that seller, whoever is selling it, right? I don't know who is selling on the other side, but I am telling him that I expect this stock to go about 290 very soon because of fundamentals and the technicals, because both of them are looking very good. There is a strong bullish movement. I am telling them that I will give you the premium. I will give you $3.5 per stock, which is $350. I will give you $350, but you have to sell this stock at $290. Even though it goes to 300, 320, 350, you are coming, you have to agree that you have to sell this stock at 290. Then, right, then if he, right, when you buy and if the transaction is completed, that means you entered into an agreement, right? So within 2 hours or within 3 hours, so if you see from 3.5, the premium, right, because the stock price from 283 went to nearly 288, right, within 2 to 3 hours on Friday, because of, again, the same thing, because everybody is looking at, there is a lot of algos which will work on SMAs, EMAs. There are a lot of people looking into the news. They had good earnings. Then stock, there is a huge movement. Stock went up by nearly $5 on the day. So my premiums I bought it around $350 per one contract, right? Yeah, if I have a big account, I will buy 10 contracts, or if I have a huge account, I may buy 100 contracts. But if we, right, within 2 to 3 hours, what is the premium now? 4.7 and 5.8. That means somewhere in between, approximately 5.2 or 5.3. That means from $350, I have $520 or $530 within next 2 to 3 hours. That means nearly $170. My investment is $350. I have nearly $170 profit within next 2 hours. So what is my return of investment? On one contract, I invested $350. I have nearly $520, $530 within next 2 to 3 hours. That means my ROI is 50%. If I bought a stock from $3, $4 move, maximum I can buy 4 or 5 stocks, my profit is $20, which is less than 1 or 2%. Whereas by buying an option where I see a huge bullish move because of fundamental and technical aspects, within 2 to 3 hours, my ROI increase it to 50%. And maybe I will take some, right? I will trim some positions. I'll take some profit. If I bought 10 contracts, I'll take out some 3 or 4. Then I will keep remaining. And because I can still see, right? I can still see there is a possibility, right? Because the resistance is at 290. It is still at 288. It is still in the upward movement. In 5 minutes, 30 minutes, everywhere it is upward movement. So it can go to 290, or it can even break 290. When it comes to 290, I may sell another 2 contracts. If it goes above 290, right, then it will become a multi-bagger. My $350 will become $1,000 or something. So, right. So that is the advantage with the options, where with a low investment, we have a high return of investment or high ROI if things go right. If they don't go right, suddenly you see some China-Taiwan news, even though all these fundamentals are looking good for this stock, that will impact much more and the stock price may go down, right? That risk is always there. Wherever there is a high, high returns, it always comes with a high risk. But I want you to understand, by buying a call, what we are doing, we are paying, this is like the premiums. The bid is like somebody is ready to buy at this price. The ask is somebody is telling that I will sell at this price. We can come to an agreement somewhere in between and we can buy it for that strike price. So these are the dates, right? So you have all these yellows are weekly expiries. Then all these are like, all these in white, they are the monthly expiries, right? So I hope everyone is clear about the option chain. This side you have calls, this side you have puts. And then, right? So let us take one more example. Let's look at another ticker which can move huge tomorrow is, right? I'm expecting mRNA can, right? Let's look at, for the short term, we look at 5 minutes. So, right, again, you can see that it on Friday, there was a lot of sell-off, and then it reached a support, a strong support. Then it started moving up. It is above the Ichimoku cloud. Tomorrow, again, if there is no bad news about some China-Taiwan war, there is a potential that it can go to nearly, right? We don't see any strong resistance. So again, there is a huge potential. It can move to 192, 196. So again, I see pre-market volume. If it is moving good, then I will basically buy calls of 190 or 195, like that. Again, what is the reason? Fundamentally, today, Senate passed a bill, right? If you saw the news, you saw that Senate passes Democrats' big healthcare, climate, and tax package. And then if you see mRNA, right? Different news about mRNA. Looking at recent whale trades, right? A lot of big organizations, hedge funds, they are investing, they are putting their money. There is a lot of option flow there. Even though the cases are declining. So you can look into the fundamental aspects, or right, price target to Goldman Sachs raises mRNA price target to 296 from 290, maintains a buy rating. So there are some positive indicators. And also, if you see, right, for example, for 12th August, right, there is something called as volume and open interest. That means how many contracts are open as of now. That means an agreements between buyer and seller, approximately 3,369 agreements are open. They are assuming that it will go to $200, right? On the put side, if you see, the volume is less, right? On the buy side, there is a lot of volume, lot of open interest, right? Volume generally gets right every day, it gets reset, but this open interest is number of contracts which are open for that strike price, for that expiry date. So you can see that there is lot of interest for this 200 strike price, right? Compared to everything else, lot of people are bidding on this. So tomorrow, if I see there is no bad news, I'll get into this 200 call, and there is a high potential because technically it is looking good. Fundamentally, there is a lot of good news. There is a bill passed on the healthcare thing. So, and my open interest volume, they are looking good, right? There are a lot of positive factors for this. So if it moves, then this, right? So my investment is approximately $150 per contract. If it moves to 2 points or 3 points, it can become 100% returns in the same day tomorrow, right? That is the advantage with the options, where with a low investment, if our fundamentals, technicals, everything go as expected, we can make huge returns, right? Right. So that is the advantage. But I hope now you got like what is open interest is nothing but the number of open contracts, right? Again, an agreement between buyer and seller. So how many contracts are open for that price, right? For example, tomorrow I buy another 10 contracts, then maybe this 3,369 will become 3,379. Okay? Like that, you just assume that how many people are getting into an agreement for that date, for that expiry. That means I am telling that I am ready to pay this $150, right? See, this 1.45 is per stock, but every option contract consists of 100 stocks. So I have to minimum buy for 100, right? Minimum as per US markets. In some other markets, it can be 50, it can be 10, it can be, right? You have some mini contracts, but as per US contracts, you have to buy an option contract for 100 stocks. So my investment is $150, and I am getting into an agreement with the seller, whoever that person, right? That is a black box for me. But that person is responsible, even though tomorrow, tomorrow or before 12th August, mRNA goes to 220 or 230 also, he is responsible to sell the stock at $200 to me, just like the house example, right? Or I don't need to wait until that time. Tomorrow, suddenly the stock price goes from 186 to 190, my premiums, right? Instead of 1.5, the premium can become $3 or $4. I can sell my contract to someone else, right? I don't need to wait until 12th August and buy the stocks at 200. I can just sell those, sell that contract, sell that agreement to someone else, right? Because that person might be thinking this mRNA will go to 210 or something. He is ready to pay more premium and buy from me. Like that, we will keep buying and selling, right? We don't need to wait until the last date. We don't need to wait for to get the assignment of the stocks. We can just buy the contract and sell the contract after some time when you see the upward movement, right? So, right, I hope everyone is clear about volume is number of transactions happening on the day, which gets reset at the end of the day. Tomorrow morning, again, if you see at 8:30, everything will be zero here. But open interest, it will continue. So if you this is one indicator. Again, just don't go with just to open interest and try to buy the contracts. Fundamentals, your technicals, SMAs, EMAs, Ichimoku Cloud, And this is one more confirmation for me. When I'm looking like which one to buy, I see there is a lot of interest here at this particular point for this 12th August. Or if you go to 19th August, right? I can see that there is again a lot of interest, right? 1927 open contracts. Whereas on the put side, it is only just few hundred. That means people are expecting that mRNA is bullish. Lot of hedge funds or big organizations, they are buying it. Even if you come down, there is something called option time and sales here, right? Where you can see what are the major sales happen on the day, right? 8.5 at 10.58. Somebody bought 200 call. How many contracts he got? 367 contracts. That means someone has some news that mRNA, right? In the morning itself, on Friday morning itself, he bought a 200 call. That means there is a possibility that tomorrow the stock can move well. And so, right, that's what this is, right? Just like VRTX, I am expecting mRNA to have a good move tomorrow. Unless, again, as I told you, if there is some news about China, Taiwan, or or sudden monkeypox cases doubling or tripling, otherwise this should move and give great returns tomorrow. But again, I look at pre-volume, pre-market, see whether this stock is moving. Some people are buying the stock, and then at the once market opens, I will get either 12th August or 19th August 200 call, where I see there is a lot of interest, right? There are people buying some 210, 220 also, but I see there is huge interest at the 200. And also based on technical analysis, I can see that there is a resistance at 5-minute timeline. I see there is resistance somewhere here at 197, right? So 200 call is a good one where I can make. If it moves to 196, my premiums will be 200, 300% from 186 to 196. So, right? I hope everyone is clear with this is like calls, whereas this is like puts. For example, I have some 100 stocks of mRNA and I want to buy a hedge, right? I am worried that tomorrow suddenly if there is some China war news, the stock may go to 150 or 150. I can pay a premium, right? For example, I want to protect minimum, I want to have $180 as the value of the stock. I can pay a premium saying like, okay, I am ready to pay $320 for every 100 stocks, so that even if stock goes to $100, he should buy from me at $180, right? This side is you are selling that you have to sell me at 190 or you have to sell me at $200. Even though stock goes to 220, 230, you are obligated. I am paying you this much premium and you are obligated to give me that particular the stock at $200. Whereas this side you are telling that I am worried that the stock might go down. I am ready to pay you this somewhere in between here. Even stock goes to 100 or 150 or 50, you have to buy from me at $180 price, right? Just like your car insurance and home insurance. And this is like an insurance. So just remember insurance example for puts before this date. This is just like buying that home example, right? I hope everyone is clear, right? Which one, right? Which one you want to take, all those things you will understand once we look at option Greeks and all those things. But for now, I hope everyone is clear about what is the strike price. That means this is the agreed price for our contract. What is the premium? Somewhere between the bid and ask, right? If I am bullish, I will buy calls. If I am bearish, or if I am thinking that I am worried, I am pessimistic, I am thinking there might be some war news suddenly tomorrow, or on Wednesday there might be some rate hike to 100 points instead of 75 points. Then if I want to protect my account, or again, even though you don't have stocks, you can just buy a put. You think that, right, for example, Tuesday or Wednesday morning, you are predicting that Fed will come with 100 points hike instead of 75 because job reports was very good. Now they think that, oh, right, people are making good money. There is no unemployment or unemployment is getting reduced. Let us increase the rates to 100 points instead of 75 points. Immediately, all the stocks will start falling. So if you predict that, you can just buy some put, right? And suddenly if this stock starts coming down, your put value will become 100%, 200%, right? As stock goes down, you even though you don't have the stocks, you don't need to hedge your stocks. If you are bearish, if you think some stock will go down, you can just buy put. And after 1 or 2 days, after FOMC, there will be a lot of volatility. There can be a lot of right panicness. And if they come up with 100 points, all the stocks will go down, the SPY will go down, everything will go down. You can make huge profit. Or if they come with 75 points itself, right, there may not be much downfall. Or if they come with 50, which I don't think generally, right, my guess is they may come with 75. But if they come with 100 points hike, then definitely there will be a lot of downfall. You can make a lot of money on puts on Wednesday, right? I hope everyone is getting it right. I want everyone to understand. If you have any questions or if you want me to repeat anything, please put it in the chat window. If you are bullish, you will buy the calls. If you are bearish, if you think stock will go down, you will buy the put. And with a lower investment, you can make money if things go as expected, if things go as you predicted or as per your assumption. But if they don't, then all our money can become zero. So that is the risk there. You have a limited period within which your guess should happen. Then somebody might think like, oh, instead of 12th August, why not I go with some 16th September, right? So I have more time now. Instead of just 1 week, I will say that mRNA I want to buy 190, but now you have more time, you have to pay more premium. For the same monthly, right, August monthly, right, which is all third Fridays, you have the monthly expirations. So here it is approximately 6.5 or 6.6 for the 190 call. You are paying $635 for one contract. Same thing if you want a next month. Now you have more time, more, right? That means more opportunity for the stock to go up, but you will be paying more premium, right? So based on if you go far and far, your premiums will increase. If that's why, right, the lotos are so attractive, because on the same day you are taking it. If stock moves up, you make huge 300-400%. But on the day if it doesn't move, our entire value, our premium will become zero. So we have to, based on our risk, based on, right, you can take, if you have a high risk or appetite, if you have a high risk tolerance, you are okay to lose this, right, $150. You will just go with 12th August contract tomorrow, right? For example, Casey sends an alert saying like, I am buying a 200 call of mRNA. You may just go with 12th August. You have a low risk tolerance. You want to be a little conservative. You don't want to take a high risk, right? Then you may go with 19th August, where your price you are paying, instead of 1.5, you are paying nearly 3.25. But you have more time for that stock to, even though tomorrow if it doesn't move, or this next week doesn't move, in the next coming week if it moves also, there is a possibility for you to make money, right? Again, there are a lot of other factors also, but on a high level, I'm giving you, I'm trying to explain you that based on the time, if the duration is less, your premiums will be less. If you have more duration, you have to pay more premiums for your contract. If you are bullish, you will buy calls. If you are bearish, you will buy puts. Again, we have vertical spreads, debit spreads, credit spreads, all those things we'll talk later. But for now, let's keep it simple: calls or puts. If you think it will go up, you will buy calls. If you think the stock will go down, you will buy puts. Or you can also be on the seller side, right? For example, you are bullish, you can sell a put. You think that mRNA will go to 200. You can make money by buying a call, or you can even sell, right? For example, by selling a 180 put, what you are telling to the buyer, you are telling him that I am ready to buy at 180, right? If the stock goes to 200, right? If the value of the stock goes up, that means all this money is yours. I hope everyone is getting it right. Only when the asset value decreases, then because you sold the insurance, you have a problem. But if the asset value, if the stock value is going up, then you have basically that whatever premium you collected. For example, we are paying in car insurance, nothing happened to our car. That means our right car value minimum, right? Leave about the depression or other things, but no accidents, nothing happened. Then the insurance company is collecting all those premiums. They are becoming more and more rich by collecting all the premiums. In the same way, you can be, if you are bullish about a stock, not only buying a call, you can also sell a put. Somebody is bearish, he will buy from you, but you are bullish because you looked at all the news, you looked at all the technicals, you see that this mRNA, there is a potential to go up to 195. You are bullish, somebody is bearish, somebody is buying a put, you can be a seller, and if stock moves up, the value of that put goes down and down, it will become zero also. That means all that money you collected, if somebody is paying $500 as a premium, that means all that $500 is yours. If the stock stays above, right, stays at 180 or above 180, that means you made all the money. So it is not only buying a call, you can also sell a put when you are bullish. In the same way, when you are bearish, not only buying a put, you can also sell a call, right? In both, you have different ways to make money from options, right? To make it simple, you can buy call when you are bullish, you can buy put when you are bearish. In the same way, you can sell a call when you are bearish, you can sell a put when you are bullish, right? I hope, right, everyone got it. Oh, I think, yeah, sorry, it seems chat was disabled, but you can chat now. Anyone has any questions on understanding, right? What is a call? What is a put? Why options are, right, better or not better, but what is the advantage of options over stocks? I hope everyone got it right. Sure, right? Yeah, I'll be explaining about why some of the call side price options are even less. All those things I'll explain. Okay, right. Repeat about selling calls and puts. Right. Again, always go back to that example. Right. Let us start with the insurance. Right. You can be an insurance company. You can buy the insurance, or you can be the insurance company. Right. Which one do you think, who makes, right? Is insurance company profitable or not? Right. Whether it is health insurance or home insurance or mobile phone insurance or car insurance. What do you think? Right. How many, if 100 people are paying premiums, how many people might be using those premiums and claiming them, right? Can you guess what is the approximate percentage? Right, yeah, very less, right? Generally 10% or 5 to 10%. So you can be, right, you don't need to be always a buyer of a call or buyer of a put. You can be on the other side also, right? If somebody is selling, it is not some Thinkorswim is selling or not some Chicago board is selling. It is only, right, I might be buying it, and KC might be selling it, or VC might be buying it, and HK might be selling it. So it is all traders who are doing, some are bullish, some are bearish about the same stock. So for example, right, again, as I told you, I can be, right, I see there is a huge potential for mRNA to move tomorrow because of all the reasons I explained in the fundamentals, technicals, because of that healthcare bill, right, moving. So one way I can make money is, I see that there is a huge open interest in volume. Volume is number of transactions on that day, on that particular day, whereas open interest is number of open contracts, open agreements for that entire period, right? It won't get reset. This volume gets reset every day, but open interest will not get reset. So I see there is a huge interest. A lot of people are buying, right? Even from here, I can see that on Friday, somebody, a big guy, right, a hedge company, if he bought 367 contracts, that means 1.2 means $120 per contract, 120 into 367. That means a huge volume. So there is some good interest, or they know something about this. Maybe they know that this healthcare bill is passing, or they may have some algo which did that, or whatever it is, right? So one way I can make money is, I can buy a call, right? I can just click here, right? This is bid and ask. So in the ask, I am clicking on that, and then I can put, right, if I want to buy 10 contracts, by automatically I populated it to 10. Then right, it is between 330 and 340, so maybe I can negotiate, right? I will try to put somewhere, right, at 3.35 or 3.3, and then do confirm and send. That means I am buying 10 contracts. Each contract is $330. For each stock, 3.3. For 100 stocks, $330. And 10 contracts, when I do confirm and send, it will show like, okay, it is, you are 3,350, and then you have some right, commission you have to pay to Thinkorswim for buying that. So it will be showing all those details, right? So that is one way. And if stock moves up, this premium from $3, it can move to $4, $5, $6 based on the move. I can again sell it off and make profits. That is one way. Or I can also, because I think based on my assumption, or based on my right analysis, this stock can move to $195 to $200 tomorrow or day after. So I think like it will not come to 180, right? Because if you see, there is a strong support here. It came down, but from support again it went up, again it moved, again it tried to come down, again the support. Support is basically where people are interested to buy that stock. It came down, again it went up. So there is a strong support here. So if I sell an option, right, if I sell some insurance at below this one, at $180 or something, that means even if it comes down, it may come up to this point, and again there is a possibility that this might bounce back. So somebody is coming in telling that, can you sell me an insurance where you have to buy the stocks at $180 from me, right? My guess, my analysis is that this stock will be between 195 to 200 in this week. If somebody is telling that, please sell me insurance for 180, right? My risk is very minimal because I am bullish. I am ready to sell the insurance to him because I feel the stock will be above 180. If stock goes below 180, there is a risk for me. But if stock is above 185, 190, 195, the premiums will become zero. If stock goes up tomorrow, these premiums will start decreasing. So I can make profits by buying a call, or I can also sell a put. I can become the insurance company. I can sell the put to someone, right? Just like I click here on the buy. Here what I will do, I can just say sell, right? Confirm and send. Then somebody will buy that, and if the stock goes up, the premiums will go down.
So I'm collecting the money here. I'm collecting approximately $5-10 for each contract. If the stock is going up, this premium will go down from 5.1. It may go to $3. It may go to $2. Then I can again buy back at $2 or something, right? Or I can just wait until 12th. If the stock still stays above 180, then all this will become this 180 option put premium will become 0. That means all $530 or $510 is mine. So especially in this bearish market, right? Recession, or if you are expecting some bad news, or you see that there is a possibility for Taiwan, or so not only you on the buyer side, even on the seller side, by selling puts or right, or by you can, right, if you are on the bullish side, you can make money. Even if stock goes down also, you can make money. There are different ways, different strategies to make money in bullish or bearish conditions. Only problem arises when market just moves up and down, right? Without, if it goes completely down, we can make a lot of money. If it goes completely up, we can make a lot of money. But if it is just in a small range, going little 2 points up and coming 2 points down, 2 points up, again 2 points down, that is where, right, all the premiums will be eaten away by time decay and implied volatility, a lot of other things which we will be discussing. But that is where we can lose. But if things go up or go down, we can make money in options or even in stocks, right? Even you can short stocks, you can make money when stocks are going down, or you can buy for long and you can sell them when they reach the targets. So again, because many of us have that opinion or think that, okay, only in bullish market we can make money. If it is bearish market or if stocks are going down, we cannot make, but it's not right, right? Again, because we are used to that, right? Buying it low and selling it high. There is some, right? Especially when you're shorting good quality stocks and suddenly stocks goes up, there is a risk. But again, as long as you have stop loss and other things, if you're doing proper analysis, you can make money even by shorting the stocks. But I hope everyone is clear about buying calls or buying puts or selling calls and selling puts. What are the different scenarios we can do and what is the advantage by buying or selling them at different, right, at a different strike price based on open interest or based on volume, based on a lot of other factors, right? It is not just open interest and volume. You have something called as layout here, right? If you click here, you can see like, okay, if I want to see delta, gamma, theta, vega for this particular strike price for this particular date, I can just change it. I can look at all those values. What is delta, what is gamma, what is theta, what is vega? I will explain all those things. But you have everything. You have all the tools in the platform itself, which will show you what is the intrinsic value, what is the extrinsic value, what are these various right option Greeks, what is the volume, what is the open interest. So you can look at multiple things and then it gives you a confirmation. There is a lot of volume, then my option Greeks are looking good, my technicals are looking good, my fundamentals are looking good, then the possibility to make money will increase more and more. Right? Again, as I told you, based on it, right? Yesterday we discussed, right? There are different strategies like scalping, you have swing trading, you have day trading, you have positional trading or long-term trading based on your risk tolerance, right? Scalping, there is a lot of money, but also there is a lot of risk. If it doesn't happen, if you cannot quickly enter or quickly exit, we might be losing money. In the same way, based on option Greeks, based on, right? You have, this is like a high risk. If you are trading the same week contracts, you are taking a high risk. If you are trading later, you are paying higher premiums, but the risk becomes lower. So it is up to you. Based on the risk tolerance, we can decide which one is good for you, right? There will be some investors with millions of dollars in their portfolio. They want to take high risk and make more. When you take more risk, there is a potential to make more money or lose money. When you take a low risk, you may make low returns, right? Risk is low, you may lose less or you may gain less. it is up to us based on our risk tolerance. We can decide, okay, should I go with the same week? Should I go with the next week? Or should I even go with the, not even this month, I will go with the next month. So monthlies are generally more low risk compared to the weeklies, right? You have every week, you have expiries, right? Not all the stocks will have weeklies. There will be many of the stocks which will only have monthly option contracts. There will be some some big companies, standard stocks, they will have weeklies and also monthlies. And you have implied volatility here. We'll be discussing all those things, but I hope it is clear for everyone on what is an option chain, what are the various components, how to change the layouts so that you can look at option weeks, you can look at implied you can look at open interest, you can look at the volume, you can look at intrinsic value, extrinsic value, everything, all the details are in the option chain itself, which will give you a lot of indicators to whether to buy them or not. There are a lot of tips which are there within the option chain, right? I have shown you one example, right? This is showing like a lot of people are buying 195 call, 195 call, 210 call, 200 call, 182.5 call, right? All on Friday, a lot of people are buying it. That means, right, if you see more than puts, you don't need to subscribe to some option, right? Some cheddar flow or something for option flow, right? You have the information is stored here, right? You have a lot of calls, a lot of people are buying. What is the biggest contract on the day? You see that 466 quantity at 36 cents price, somebody bought a 210 call. That means he is much more bullish. He is thinking that by 12th August, or it need not go to 210, even from 185, even if it goes to 190 also, this 36 cents can become 60 cents or 50 cents. They can make good profit, right? It doesn't mean that it should reach to that value to make money. If it moves in a positive way, in a bullish way, they can make profit. So if I look at 12th August, I see there is a lot of open interest. 19th August, there is a lot of open interest. So there is definitely a huge potential for mRNA to make a good move, unless we see some very bad news about China-Taiwan war or something, right? I hope that is clear on why to buy option contracts, or what is the advantage of options. With the low investment, we can make quick returns if things go as expected. Right? And other terms which you all need to know is what is ITM, ATM, OTM. Sometimes in the channels you will say, okay, the option is at OTM or option is at ATM or ITM. So what do you mean by that? In the money, that means if the strike price is less than the stock price. Right? Let me show you. So, right, let us take this example. Again, mRNA, right? This is our favorite stock for tomorrow. Even VRTX and then even Viro, NVX. I'm expecting a lot of healthcare stocks to move well tomorrow, right? So, if what is the strike price is $200. What is the current stock price? It is approximately, right? If you these are like after market prices, but the market at the end of the market, the price is 186.84. So if you don't need to buy somewhere even in the future, right? Even you can buy a 170 call. You can even buy a 180 call, right? You don't need to always buy a 200 call. Even you can make money by buying in the money. That means if the strike price is less than the current stock price, these are like in the money. That means already these are in the money, right? So your stock price is at 186, whereas your strike is at 170 or 175 or 180 or 185. That means, right, these are already highlighted. You can see, right? All these are like in the money on the call side. On the put side, all these are like in the money. Whichever are highlighted, they are in the money, right? Again, to avoid confusion, forget about puts for some time. Just think about the call side. So if the strike price is less than the stock price, your options are in the money. For example, tomorrow the stock moves to, right? I am buying a, let us say, tomorrow morning I am buying a 190 call. And stock goes to 195. Then what happens to my my option contract? It becomes in the money. As of now, it is out of money. But when the stock is moving from 186 to 191 or 192, this also becomes highlighted. This also becomes in the money contract. That means there is more profit potential. Your moves will be much more quicker. Why people will buy, why hedge funds, why big companies buy these in the, right? You can see there is a 2,670 open interest. There is a 1591 open interest. Why people buy those, we'll discuss, right? Once we discuss about delta, you will understand what is the advantage of buying in the money contracts. It doesn't mean that always you have to buy somewhere out of the money, right? So what do you mean by at the money? If I am buying 190 and tomorrow stock reaches to 190, that means exactly your strike price is equal to stock price. That is called as at the money contracts. If your strike price is far away from the current stock price, those are called as out of the money, right? So in the money, at the money, out of the money. I hope everyone is clear, right? If the stock price is more than the strike price, so this is strike, you can see, right? Then they are in the money contracts. If stock price is equal to stock, if stock price and strike price are equal, then it is at the money. If your strike price is greater than your stock price, then they are called as out of the money contracts. Generally, right, most of the new traders, or they try to buy, because you see the premiums are very low here, 60 cents, 70 cents, 220. They tend to buy a low premium, assuming that, right, even stock moves a little bit, my premiums will go up, I'll make money. But again, there are a lot of factors, right? For stocks, you have only two options, either it goes up or comes down. But with options, there are a lot of parameters we need to look at. We need to look at what is the intrinsic value, what is extrinsic value, what is delta, what is gamma, what is theta, or what is open interest, what is volume, right? There are a lot of factors which are involved with options. If we can look at those things, and if we can take right trades based on our risk appetite, there is a huge potential to make money. But if not, there is a high risk. So I will be explaining you how to right, what is that intrinsic or extrinsic, all those things we'll discuss one by one. Let me see chat to see. Right, you will be able to see, right, again, if you go to the layout, if you have all these options where you can see volume, open interest, or you can see all the Greeks, option Greeks. You can see intrinsic value, extrinsic value, all those things, right? We'll go one by one, right? Again, I know I might be repeating. If you are already an experienced trader, you might be feeling bored, but I am trying to see all the new traders also, because right, most of the times we lose money because of not understanding the concepts or not understanding what we are doing. We'll be just taking some based on the FOMO. Somebody puts a trade, we take a trade without understanding, right, whether it is based on our risk tolerance or not, whether, because there are hundreds of members, each one with a different type of risk tolerance, each one with a different type of, somebody having $1 million account is also trading, somebody with a $5,000 or $3,000 account also is trading. Sometimes if we understand these concepts, it makes it better, right? If you understand, oh, if I buy a same day contract, there will be high theta. Suddenly, if stock doesn't move, my entire premium can become zero. Then you know that if you are a small account holder, if you have a low risk tolerance, that option contract is not for you. If you are a big account holder, right? You don't need to, right? You have a higher risk tolerance. You can take even though same, because they may become 300, 400%, or they may become 0%. You can take. So understanding the concepts, understanding some of the terms, understanding these option Greeks will help us to decide, right? Because analyst cannot put everything saying like, oh, I am buying this, the alpha, right? This is the gamma, this is the theta, this is the vega, or this is the open interest. If we even don't know what are those terms, even they post that also, it may not make sense. And also things move so quickly. So if they try to add all those things, by the time they put everything, already the premiums might go up by 10%, 15%. So that's why having knowledge will help us to understand whether that position, right, whether that alert is for me or not. I have a small account, I have a low risk tolerance, that alert is not for me, right? That is a same day trade. If it doesn't go right, it can become zero. So let me skip it. Let me take a low risk trade like that. So that's why it is very, very important for us to understand various terms or various concepts like all this, right? Open interest, volume, option Greeks, right? Let's go to the next. I hope everyone is clear about in the money, at the money, out of the money, right? Then let's look at the most important concept in options. That is the option Greeks, delta, gamma, theta, vega, rho, right? By looking at the names itself, we feel tensed because, right, we all know that these terms seem so complex, or these terms, the names itself, right, they seem like Greek and Latin. So yeah, the words are from Greek, but we generally tend to avoid without understanding what those things are. But it is very, very important to understand these things and understand how each one will impact the trade, or is the trade, right? Based on the delta, based on your risk tolerance, you can decide whether to take it or not. Based on the theta, you can decide whether the trade is for you or not, right? If you are a low risk tolerance guy, you have a small account. If it is a high theta, right? For example, GameStop, or right, some high volatility, or there is a very low, right? Just 1 day expiry or 2 day expiry. The theta is too high. Your premiums get eaten like anything. So then those trades may not be for you. So that's why understanding these concepts is very, very important. We'll go, maybe, I don't know, we may be able to cover all the Greeks, but let's try to do minimum 1 or 2, right? First thing we all need to understand, right? Our premium, we are paying a premium. When you are buying a call or when you are buying a put, you are paying some premium, right? That premium is not just depending on the option contract price. There are a lot of other factors involved. There are a lot of other components involved in that premium, right? It is not just, okay, if it is 200, it is 3.3. If it is 205, it is 2. Somewhere between 2.14 and 2.32. It is not just based on the price, but there are a lot of other factors also. So let's look into, right, what is this, right, intrinsic value and what is the extrinsic value. Within extrinsic value, you have again 2 major components. One is the time value, one is the IV value, implied volatility value. So if you are paying some premium for a call or for a put, or you are collecting a premium, it is based on multiple factors, not just, right? For stock, it is just the price. Price goes up, you make profit, price goes down, you make a loss. But sometimes, right, in the options, you, right, for example, you bought a $190 call for mRNA, or you bought a $200 call for mRNA. If mRNA quickly moves to 200 tomorrow, right? You bought a 19th August, $200 call for 3.25. That means your investment is $325. Tomorrow itself, it moves to 195 or 200. You may make 300, 400% returns on that. But the same, for the same strike price, for the same expiration, tomorrow it may move $1 up, day after tomorrow it comes down, again after 2 days it goes up, again after on Thursday because of, on Wednesday because of this FOMC, it comes down by 10 points. Then again on Friday it goes up by 10 points. On 19th August, it may come to, let us say 199 or 200, even though it might reach the, right, whatever price you thought, you may not make any profit, right? It is not that, right? It is not like our cricket betting or something. If India scores 200, you will win, or if India doesn't score 200, you will lose. It is not like that. You have a lot of factors involved, right? Is it, if tomorrow itself it goes, then you make huge money because there is no time decay, there is no theta, you have a high delta, high gamma, all those things. You make huge profits with directly from this point, right? From 186 without any disturbance, without there is no bad news tomorrow, right? Then quickly it goes to 196. Your premiums, you will be so lucky, right? You will be, your premiums may become 400 to 500% up. Your returns will be 400 to 500%. But if stock goes to some 2 points up, comes down, again 2 points up, again comes down, again 2 points up, even though it reaches that, we may not make any profit for that price. Why? Because of all these components called as time value, implied volatility, all these things. So let us try to understand one by one. What is intrinsic value? What is extrinsic value? What do you mean by time decay? What is implied volatility? Let us understand one by one, so that we can, right? It makes it more, you can be more confident when you enter into a trade. You can take better trades based on your personality, based on your portfolio size, based on your risk tolerance, instead of just taking some trade because somebody gave some trade. You don't need to take the trade because that trade might be for a big shot with $1 million account. That trade may not be for you with a small dollar, right? And because we have 600, 700 members, we don't know who got 5,000 account, who got a 100K account, who got a $2 million account. The analyst will just post trades based on, right? There are so many factors which will determine whether it is a high risk trade or low risk trade. So, right, let us try to understand what is this intrinsic value and extrinsic value. So if you see, again, let us take the $200 example, right? mRNA for 19th August, strike price is $200. If you are paying, right, somewhere in between this, you don't have any intrinsic value. Your entire money you are paying is for, right? As I told you, the premium, whatever premium you are paying, it is a combination of intrinsic plus extrinsic. If you are taking any out of the money calls, then your intrinsic will be 0, right? That means your 3.275, you are paying only for the time value and for the implied volatility value. Only for those two things you are paying the premium. Let us take this example, right? Let us take some $180 example. Somebody is buying a 180 call. Then how much premium he is paying? Somewhere in between these two, 11.45 and 12.35. So what is the current stock price? 186.84. What is the strike price he's buying? 180. That means approximately he already has a value of, that means if he is buying this strike price, he already has some value for this contract because the stock is at 186. He is buying a 180. So there is already an intrinsic value of $6.25. That means all the in the money strikes will have an intrinsic value. That means already they have, if you are buying a contract, that means you already have some value. Even though right? Even though there is implied volatility, all those things, still you can make some money from that. So why those hedge funds buy these things, we'll see later why they buy this in the money contracts. But intrinsic value is nothing but the difference between the stock price and the strike price. That is interest. So if you are taking 167.5, 186.5 minus 167.5, approximately 18.75. If you're buying a 170 call, in the money call, 186.85 minus 170, approximately 16.85 or something, right? So that is your intrinsic value. So the difference between the stock and the strike is the intrinsic value, whereas you are paying additional money for the implied volatility and the time decay. What is implied volatility, time decay? I will explain, right? So, but understand that whenever we are paying a premium, if we are only paying for intrinsic value, if the premium is only intrinsic value, then if stock goes to that point, the $200 by this time, we have to make profits, right? If you don't have these two factors, time value, implied volatility, if our premium is only for intrinsic value, and if you guess that it will go to $200 before 19th August, if it goes even on 19th August, if it goes to 200, we have to make good money. But because you got these other components, other factors, which will define whether you will make profit or not, even though stock goes to 200, but if it is not going quickly, if it is going up and down, up and down, up and down, and suddenly on last day, if it goes to 200, you may not make profits because of these two factors called as time value or time decay and the implied volatility. Is everyone clear what is intrinsic value? The difference between the stock price and the strike price. So if you take 186 minus 190, right, there is no positive value. That's why your intrinsic is 0. 186 minus 200, it is a negative value. So that's why your intrinsic is 0. So whatever premium you are paying is only for these two components you are paying, for the time value and the implied volatility, but you are not paying any intrinsic value as part of that, right? Is it making right? Are you able to get it? Right. Again, I am showing Thinkorswim. This is a product of TD Ameritrade, and yeah, right. This is one of the best tools in the market. It is a free tool. You can subscribe. You can easily, right. It is a good tool for options or for stocks. Definitely one of the best tool in the market. Anyone, right? Is it clear about intrinsic and extrinsic, or is it getting too much? Right? But only thing I want you all to understand, right? Because generally, right, when you look at that house example or insurance example, we think like, oh, if I am buying 200, if stock goes to 200 by that time, I have to make money, right? That's what is our assumption, right? I am guessing, I am predicting, I am betting that the stock mRNA should go to 200 before 19th August. So if it goes before 19th August, I have to be in profits. Generally, right? On a high level, we have to be in profits. But if it goes tomorrow itself, I may make 500, 600%. If it goes day after, I may make only 450%. If it goes on Monday, I may make 250%. If it goes on next Friday, after a lot of ups and downs, then I may not even make any profit. Why? Because of these two reasons called time value and implied volatility. So again, to explain what is time decay or time value, let's take this example, right? We all do a lot of shopping in Target or Best Buy. Let us take a Best Buy example. Let us say I have a coupon, I have an offer which you can use until until December 31st. That means you can use for Thanksgiving, you can use for Christmas holidays, for 50% off on any item up to $1,000, right? You can get 50% off on any item in Best Buy using that coupon or using that promo code for up to any $1,000 item. That means $1,000 item, you will get it for $500. And you have time until December 31st. If I say that I will sell that coupon for $500, do you think anybody will buy it? Or let us say I will sell the coupon for $100, right? You can save $500 if you buy any item in Best Buy until December 31st. Do you think it's a good deal where you are buying for $100, but you are saving $500? That means nearly $400 is a profit for you, right? I hope that is clear, right? $100 coupon. You are buying a coupon from me for $100, but you have time until December 31st. If I say that, right, not December 31st, but now I am telling you that that coupon is only valid until end of September. Will you be still willing to pay $100, or do you want to give a less price for the coupon? Because now you cannot use it for Thanksgiving, you cannot use it for your holiday shopping, or if you are planning to go to India, you cannot do any shopping. So now you have a limited time, limited period to use the coupon. Instead of 100, you may be ready to give only $50 for the coupon. You have only 2 months to use it. If I say that that coupon expires end of August, you may not be even ready for 50. You may say that, right, I may not be able to do any shopping by end of August. I'm okay if I have to pay $20, right? You still have a possibility of saving $500, but as time gets reduced, you will pay lower and lower price for that coupon. That is right. Again, if I say it ends by this week and end of 12th or by, then you may even say, right, I won't even buy it, right? I won't take a chance to buy it. I may not even use it, right? Even if you pay $1 also. So that is called as time value. Based on the time, your option premiums will increase or decrease. So that's what I told, right? If this mRNA moves well tomorrow itself, we may make 400-500% on that premium. But if it doesn't move tomorrow, day after tomorrow, it is moving to the same strike price, but it is taking some time, right? There is more time decay. Every day you are losing some money. Every day it passes. If it passes tomorrow, then you are not losing much. You are buying tomorrow, it is moving tomorrow. There is no theta decay, there is no time decay. You are not losing any time. You make huge money. But instead of moving tomorrow, if it moves day after tomorrow, you will make little less profit. If it moves after 1 week, you may make much more less profit. If it exactly moves on 19th August, you may not make any profit. So that is called as time value, right? I hope that example is clear. If you have more time, you are okay to pay more price. If you have less time, so in the same way, if you buy something immediately, price goes up, your premiums goes up so high, your profitability will be so high. But if it doesn't, your profitability will keep coming down. There is a, right, it is called as theta. We'll be discussing that, but for now, understand the terms, that is called as time value. If you lose the time from when you are buying and when it is meeting the criteria, your profits will go down each and every day. So in the choppy market, if market is either completely bullish or bearish, that's why we can make money. But if market is going up, coming down, going up, coming down, going up, coming down, you are losing all the time. So all your premium, right? You are paying out of the premium you are paying some money for time, some money for volatility. That means all this, you are losing time. That means all this money is becoming zero. Whatever you paid, let us say you paid 3.275. Out of this 3.275, let us say $2 for time decay and another $1.2 for implied volatility. There is no intrinsic value here. All the $2 will become zero if it is not moving quickly, right? In the same way, what is implied volatility, right? Let us say if you take stocks like GameStop or AMC, or there are some stocks where they are too volatile, right? They go suddenly, they go so high, suddenly they come down, right? If you take Austin as an example, real estate, right? It is so volatile, it moved so high. If there is some recession or layoffs, it can come down. It is so volatile. So based on the volatility of the stock also, right? Not only based on the time, based on the stock price, based on the volatility, how the movement is. The stock is moving so high, coming down, again moving high. Then also your premiums can go down, can become zero. So assume that whatever you are paying is of three parts. One part for the price move, one part for the time decay, one part for the volatility. If the stock is just going bullish and reaching there, then you make huge. But if it is coming up and down, you are losing time. There is a lot of volatility. So you will, all that part which you paid for implied volatility and for the time value, that is becoming zero, right? So that's why even though your stock goes to $200 by this time, but you may not make profits because of that two reasons. It is taking a lot of time, or there is a lot of up and downs in this duration. That's why your premiums can become zero. So again, right? We have Vega, we have theta based on time decay, Vega based on implied volatility. We have delta, right? We'll be discussing all these, right? I know it is already 9:30 and tomorrow is a working day. There are a lot of members messaging that they are from EST. But I want you to understand on a high level, right? Based on your, so here you have intrinsic value. So based on this, we have delta and gamma, right? Based on the price moves, based on every dollar move, or based on the delta move, you have delta and gamma. Based on the time value, you have theta. That means if you have more time, your value goes slow. But if you have only one day for the expiry, the time value will go down so quickly, so the risk will be more. Same thing with implied volatility, right? Vega, where if the stock goes directly up, you make money, but if it goes up and down, if it is too volatile, going up and down, and right, you don't know whether it will, there is no, right, constant movement. There is a lot of, right, you are not able to predict whether it will go up or go down. There is a lot of up and down movements, right? So whatever, right, you are seeing delta, gamma, or based on your intrinsic value. Your theta is based on your time value. Your implied volatility, which is nothing but Vega, right? So again, if you have a low risk tolerance, you go with low delta trades, right? Because for example, for every dollar move, delta suggests like how much your option premiums will increase, right? Let me show one simple example here, right? Let us take the same example. So the delta for this $200 is 28 cents. That means if the stock moves from 186 to 187, your premium will move from, let us say, from 3.5 to 3.78. If it moves one more dollar, another 3.78 plus 28, plus also it adds gamma. Like that, based on, right, if you have a low risk tolerance, you will take delta with low risk, right, with less than 30 or less than 40 or less than 50. If you have a high risk tolerance, right, you have a big account, then if stock moves by $1, right, if I'm buying a 170 call, if it moves by $1, I make 77 cents, whereas here you make 28 cents if you are buying a 200 call. But if I buy a 170 call, if stock moves up by $1, 77 cents, that means $77. I make $77 profit for every $1 move. Whereas here I make only $28 move. So that's why these hedge funds or big companies, they buy in the money calls where there is a huge potential. That means if it is going up, if they buy 167.5, their every dollar move, they make 81 cents, $81. So if it moves from 186 to 196, they make huge money. Whereas you will be making only $28 for every dollar move, like that. So we understanding these things, right? If I have a low risk tolerance, I am okay to take this, right? If it goes up or if it goes down, I lose only 28 cents for every dollar. If it is going down, I lose 28 cents. If it going up, I make 28 cents. Whereas if you have a high risk tolerance, you have a bigger account. If it goes up, you make 81 cents profit for every $1 move. If it goes down, you lose 81 cents for every $1 going down. So that's why it is important to understand these things, so that you know that, oh, when somebody gives it, immediately you see here, oh, it is 28. Okay, it is good. I have a low risk tolerance. I am okay to take anything less than somewhere around 30 delta or 30 cents delta, right? Where if it goes up, you make 28 cents. If it goes down also, you lose 28 cents for every $1 change in the stock price. So, right, again, with that, I don't want to confuse you or explain so many things on the same day, right? I thought I can cover minimum, delta and gamma, but right, I hope minimum you got, right? On a high level, we discussed what is this in the money, at the money, out of the money. On a high level, what is delta, gamma, theta, vega, why the premiums, right? What are the components in the premium? Why sometimes even though the stock moves, why sometimes we may not make good profits, right? So because of all these components. So, right, in the next session, we'll discuss about, right, much in details about all these things. We'll also discuss about, right, debit spreads, credit spreads, right, some low risk strategies, right? Make calls and puts is, right, is like a high risk. If you buy a call, if it moves up, you make good money. If you buy put and if it goes down, you make a lot of money. But with vertical spreads, or there are other low risk strategies where you can reduce the risk. So even though it goes up or goes down, also you can make some money, like that. We'll also discuss some low risk strategies in the next session, right? We'll continue discussing the option Greeks in detail, and then we'll also discuss about some other strategies, so that you can, right, you before taking trades, you understand why you are taking trade and what is the right, what is the delta, what is the gamma, what is the theta, right? Theta, if it is a, right, immediate, in the next week you have high theta, right, you lose 68 cents every day. Whereas if you are looking for 19th August, you lose only 37 cents every day, right? The time decay, time value, like that. We'll discuss more in the next session. But yeah, if you have any questions, you can post in the window, and I'll explain them. SPX, you can see in Thinkorswim. If you click SPX, you can trade SPX in Thinkorswim. Right, I am using Thinkorswim tool, TOS, which is a product of TD Ameritrade. If you go to TD Ameritrade website, you can download this tool, and you can install it. It is a free tool. Right, the time decay, volatility, they will be different for each strike price. They will be different for each stock. So yeah, it varies. So you can see the implied volatility is shown here for that strike price. So, right, the generic. Yeah, I will take the follow-up class to explain all the Greeks. Basically, BTO means buy to open. You are buying something, right? As I told you, you can buy calls or you can buy puts. BTO stands for buy to open, whereas STC stands for sell to close. You are selling something, you are closing your position by selling it. Again, if you are on H1B, again, I'm not an attorney, I can tell right how many trades you can take, but again, your account can be, right, your wife might be taking trades on your account, or so, yeah. Right, yeah, Thinkorswim is the tool of TD Ameritrade. And as I told you, right, some tickers which can move, mRNA, and then I can see we already saw VRTX, right? It has a good potential to move. It is already above the cloud, already crossed all the EMAs, SMAs, all those things, and it can go much more higher. And other ticker which NVAX, right? It has earnings this week. It is also right above the support, going above the cloud. And if there are no bad news, we can see it reaching to $62 tomorrow or day after. So, right, yeah, these are the three stocks you can, right? You can look tomorrow: mRNA, NVAX, and VRTX. I can also see CLH, right? CLH is another stock which has earnings, and I see there is a huge potential for this stock too. Tomorrow we can see that tomorrow, day after, right? It has a strong resistance at 110, right? If it breaks out, then it can move nearly $10 up. So there is, right, this is another stock which has a huge, right? If we can buy calls on this, we can make good returns tomorrow, day after, right? So like that, again, there are a lot of strategies, right? Looking at technical analysis, fundamental analysis. There are a lot of ways we can determine which has a high possibility to move and where we have a high potential. There is always that risk, right, with that fundamental news, some bad news coming out. But if nothing comes out, then all these stocks, CELH, NVAX, and then VRTX, mRNA, these are looking very, very strong for tomorrow and day after. Right? Yeah, thanks everyone for joining in, and have a great night. We'll continue next week. Yeah, we'll be doing a lot of sessions, right? I'll be sharing for day trading what two things we need to see, for swing what we need to see. We'll be doing a lot more sessions so that everyone can learn as part of this process. Good night, everyone. Have a great week, and we'll continue again next weekend.